Hi, good afternoon, everyone. Hope everyone is good. Thank you for registering and joining operational case study support sessions, which is exclusively for May and August window, because as you are aware, the pre-scene for these two windows are same. Okay, so we have Mr. Harshan Madhushanka as a faculty from Sri Lanka. He is ACMA, CGMA, ACCA affiliate and ASA USA, Australia, sorry. With the help of his teaching, many of students hold global rank along with the All India rank in case studies like OCS, MCS, and SCS. He teaches to the very prestigious universities like Christ universities in India, plus he teaches to the Sri Lankan universities as well. This session we have arranged to help you in the CIMA operational level qualification, and we want this learning to be very interactive. Hence, we are requesting everyone, if you have any questions regarding the topic or anything, please drop a question in the chat box so that faculty will answer the questions. And if you have any bandwidth issues, you can close your videos or any part of that. If you have any question you want to ask directly to the faculty, you can raise your hand and then you can unmute yourself and ask the question to the faculty. So please, student, take the advantage of this session. This is a full-fledged sessions which we have arranged to all the students. Thank you. And Harshan, over to you. I'm giving you a host right.
Thank you, Neelam. Hi, guys. Good evening to all of you and welcome to the OCS support program targeting the May 2023 and the August 2023 operational case study. So I will be guiding you for subjects P1 and F1 and also for subject OCS. Okay, so today, as per the schedule, I will be taking up a lesson from subject P1. All right. So before I start, I would like to quickly ask all of you, guys, do you all have prior knowledge in management accounting? And if so, through what exactly? Is it through CIMA BA2 or is it through some other course that you have studied? If you all can respond through the chat. Do you all have any prior experience or prior knowledge with regards to management accounting? Anyone? Okay. A few of you are responding saying yes. I would also like to know how exactly or what exactly, what knowledge do you have, or is it through a degree or is it through some CIMA exam that you have done, which might be BA2? Okay, we have studied in our previous semesters through BA2. All right. So we have a couple of students who have not studied management accounting previously. Anyway, that's not an issue, right? That's not an issue because with your basic knowledge in costing and accounting, you will be able to understand the content covered in this subject. All right. Okay, so let me, before I start, guys, were you all able to download the tutorials that were in the Google Classroom? I think all of you have access to the Google Classroom. Yeah. So today I will be covering tutorial number 1 and tutorial number 2. Now, tutorial 1 basically looks at a refresh of the previous areas like what you have studied for subject BA2 or from your previous studies. So I will be covering that area quickly. And then in tutorial 2, we will be looking at a very important lesson, which is marginal and absorption costing. Google Classroom link. Okay, let me just share it with you.
Harshan, I just want to
Yes.
say something. Yeah,
Yes.
students, the Google Classroom link we have shared with those students who have booked their May and August exam. So if you want to access the material which has been provided by the faculty along with the recording of the sessions and everything, you should book your exam and let us know so we can provide you the access regarding the same.
Okay. Right. So, guys, I will share my presentation with you and I will start our session now. Okay. So the subject that we are looking at is P1 Management Accounting. Now, guys, your operational case study is an integrated case study from 3 subjects, P1, F1, E1. Now, E1 is not tested in a great on a great range. You will only get a very few areas for OCS from subject E1, but the main trigger for your OCS will be this subject P1. Roughly around 50 to 60%, roughly around 50 to 60% in your exam will be from this subject, and that is why I have allocated a little more time for P1 compared to E1 and F1. Right, so what are the areas that are covered in this subject? There are 4 areas: cost accounting for decision and control, budgeting and budgetary control, short-term commercial decision making, dealing with uncertainty in the short term, right? So we will be covering all 4 areas to a level that is required for the case study. Now, I will not be going into a very great level when it comes to numbers, because in your operational case study exam, you don't have to calculate the numbers. You don't have to do any calculations. In fact, calculations will be done for you, and you will have to make use of those calculations and explain certain things, right? That doesn't mean that you should completely ignore calculations, because unless you know how to do the calculation, you won't be able to interpret it, right? So for example, if there is a costing profit statement for marginal and absorption costing, and you have to explain certain things, you should be able to do that. Or if certain variances are calculated and there are certain mistakes in the assumptions made, you should be able to explain that. So although you don't have to perform numerical calculations, you still have to know the theories, concepts, and the methods, right? Okay, so Neelam already introduced me, so I'll just skip this slide. Okay, now I'm going to skip through a few of these slides because these are covering very basic information or very basic theories from management accounting fundamentals, right? So I will straight away go into things that are important for the case study. Now, why should a business calculate cost? Some of the reasons would be to set a price for the goods and services, to value the inventory. To calculate profit, you need to know your cost correctly, because profit is basically income minus expenses. So you need to know your cost. To make decisions with regards to controlling cost, right? Cost control. Then to prepare your budgets, right? To plan ahead for the future. To evaluate the performance of your staff and the business overall, right? So these are some of the reasons as to why we need to calculate cost. Difference between financial and managed cost accounting, we can skip through that. Okay, now just look at some product in front of you. Can someone quickly tell me a product that is in front of you? A tangible product. Anything that you see in front of you right now. Television, laptop, phone, calculator. water bottle. Now, when it comes to, okay, let's take a television, for example. Let's say a television that was produced by Samsung. Each television that they produce will count as inventory, will count as stock. How do you value the cost of one television? What are the costs you should include? What are the costs you shouldn't include? Anything you include in the inventory value, we call it inventory cost. For example, the material that has gone into the television, the labor cost of people who have been producing the television. So basically, production related cost. So inventory cost would be production related cost. So when you are valuing the inventory or the stock, you should only consider the production related cost, right? So for example, direct material. Then there are some costs which we don't include in the inventory value, and instead we take it as a period cost. Like for example, the rent paid to the office, the salary paid to the accountant. Why are we not considering them in inventory? Because they are not production related. Okay, costs that are excluded in the inventory valuation instead treated as a cost for a time period or period of time, right? Non-production cost. So inventory cost refers to any cost that goes into the inventory value. Period cost refers to any cost which you don't include in the inventory value, but instead consider as a cost for a particular period of time. It might be 1 month, it might be a week, it might be a year, right? And so on. You can skip this part also. Okay, importance of management accounting. Now, when it comes to management accounting, there are 3 extremely important words that you need to know. What are the 3? Planning, controlling, decision making. Everything in management accounting which you study will be connecting to one or more of these 3, right? Now, for example, if I ask you budgeting, budgeting falls into which one? Budgeting. Obviously, budgeting falls into planning, right? Budgeting falls into planning. Then investment appraisal, investment appraisal. Decision making, variance analysis, variance analysis, variance analysis. Controlling, you're comparing between the expected cost and the actual cost, and you take control action if there is a variance. Okay. Now, traditionally, a management accountant was expected to simply report the performance, right? Simply report the performance. But now the role of the management accountant has changed. Management accountant is no longer someone who is simply good with numbers, someone who gets the costing reports and the income reports and the profit reports prepared and submit on time. That's not the only role of the management accountant. Now the management accountant is considered as a more valuable person, someone like a consultant, right? The traditional role of reporting performance is still happening, but in addition to that, not only would a management accountant be reporting, but also enhancing performance. How? By giving suggestions, by advising, right? By monitoring certain aspects. So the role of the management accountant has broadened over time. Okay, now there's something called the CGMA cost transformation model. Guys, I want you to go to the tutorial number 1, or if you don't have the tutorial, that's okay. If you have taken a print of the tutorial, you see there's an area called the cost transformation model. Either on the printed copy or in your notebook, please mention that this is a frequently tested area in your OCS. This is a hot topic. Okay. CGMA cost transformation model is a frequently tested area in operational case study. Please make a note of it. Please make a note of it. Almost every time there is at least one question from this particular area. And I would say it's a question that is very easy to score. Okay, it's very easy to score. So just make a note in your writing book. CGMA cost transformation model is a frequently tested exam topic. Okay, there's a question, how do I access this? Now these presentation slides I will be uploading after the class is over. There's a Google Classroom and it's only accessible by students who have already booked their operational case study exam. So once you book your operational case study exam, you will get access to the Google Classroom and all the material. Okay, all right. So I will be explaining this cost transformation model in detail towards the end of this chapter. Right, classification of cost. Now, before I show you the remaining part of the slide, with your knowledge in costing, guys, can you all tell me what are the different types of cost that you know? How do you classify cost? What are the different categories? Please feel free to unmute and give the answer, or you can use the chat option. What are the different categories of cost that you have heard of? Since you all have studied management accounting before, I'm sure most of you can mention. Yes, very good. Direct and indirect cost. Okay, that is the classification by nature. What else? Variable. What is the opposite of variable? Variable cost. Fixed cost. Very good. So that is where you're classifying the cost by behavior. Variable cost, fixed cost, semi-variable, step fixed cost, and so on. You can also look at by function, production and non-production cost. So there are so many different categories. Yes, material, labor, and expenses. That's another category, right? Then you can also look at relevant and non-relevant cost. Okay, so we'll be discussing some of these popular classifications. We'll be primarily looking at the classification based on behavior and based on nature. So based on behavior, you have variable cost, like direct material, direct labor, sales commission. Now, how do you, let me ask you, do all of you know what is a variable cost? Do all of you know what is a variable cost? Yes or no? Do all of you know what is a variable cost? Okay. A variable cost is a cost that will change with the number of units you produce. Now, for example, if you consider your smartphone has one battery. So if Apple or Samsung produces 100 phones, it will have 100 batteries. So the cost for the battery is a variable cost. It's a part of the material, which will vary proportionately with the number of units, right? Sales commission, you'll have to pay a commission for each and every unit you sell. So if a cost is changing with the number of units, we call it a variable cost. If the cost is not changing, we call it a fixed cost, like rent, depreciation, supervisor salary, office salary, and so on. Okay. Now, if you consider variable cost, this is what the graph will look like. If you don't produce anything, there is no variable cost. As you keep producing more and more units, notice that the line will move up. And notice that it is proportionate, right? Let's say for 10 units, the cost is 100. 20 units, the cost will be 200. Okay, so variable cost is proportionate. So two features of a variable cost. The total variable cost will increase proportionate to activity level. It will increase proportionate to activity level. Guys, what can you say about the variable cost per unit? What can you say about the variable cost per unit? As output increases, what do you think will happen to the variable cost per unit? Variable cost per unit will, what will happen? Anyone? Exactly, Sharon, that's right. Variable cost per unit will remain constant. So if 100 is the cost for 10 units, the cost per unit is 100 divided by 10, that's 10. 200 is the cost for 20 units. 200 divided by 20, that's still 10. So variable cost per unit will theoretically remain constant. Right. Then let's focus on fixed cost. What can you say about the fixed cost? Total will remain constant. Total fixed cost will remain constant. What do you think will happen to fixed cost per unit as we keep producing more and more? What do you think will happen to fixed cost per unit as output increases? Total fixed cost does not change, but fixed cost per unit keeps reducing. Just imagine 5,000 is the cost for 100 units. What is the cost per unit? 5,000 divided by 100, that's 50. If you produce 200 units, still your cost will be 5,000. Now what is the cost per unit? 5,000 divided by 200 is 25. So fixed cost per unit keeps reducing as activity level increases. This is also referred to as economies of scale, right? When a company is able to produce in large quantities, they can enjoy cost savings through economies of scale because the fixed cost per unit keeps coming down. All right. Okay, before I proceed to the next slide, can I quickly get a confirmation? Guys, are we clear? Is everyone clear with the content covered in this slide? Okay, now you don't have to take screenshots or you don't have to copy this because after the class is over, I will be sharing these slides as a PDF in the Google Classroom. Darsh, economies of scale refers to the cost per unit reducing when you produce in large quantities. Because the fixed cost per unit keeps falling when you produce more and more. Okay, that's what economies of scale primarily refers to. Okay, moving on. Now, there are some costs which will have a mix of fixed and variable cost. What do we call this? What do we call this? Very good. We call it a semi-variable cost. Or before we discuss semi-variable cost, we need to look at the practical limitations of these assumptions. What are the practical limitations of these assumptions? First one, direct labor. Now, normally we consider direct labor to be a variable cost, but practically, you need to understand that most employees in companies get a fixed monthly salary. So direct labor cost is practically not a variable cost. It's more of a mixed or a semi-variable cost because most employees will get a fixed monthly salary. On top of that, they might get overtime and other piece-related payments, like the payment paid for the number of units you produce. Then second one, yeah, even bonus. Variable cost per unit, we normally assume that it is constant. But remember, variable cost per unit can reduce if you get discounts. Now, if you remember the variable cost per unit, it's the assumption is that it will remain constant, but practically, if you get discounts or if the employees start working faster, then the cost per unit will come down. Also, sometimes variable cost per unit can increase. Now, for example, if you are giving your employees an accelerating bonus, that basically what that means is you are telling them, okay, up to 100 units, I will give you a bonus of $5 per unit. But if you produce more than 100 units, I'll give you a bonus of $7 per unit. Now, the variable cost per unit will increase, right? So practically, assuming that variable cost per unit is always constant is not exactly right. Even fixed cost, it can change or it can increase after a particular activity level, and we call it step fixed cost. Okay. Right. Okay, there's a question. Neelam, there's a student asking whether Google Classroom can be accessed if the August exam is booked.
Yeah, definitely. If you booked an August exam, you will get an access because the pre-scene is same.
All right. Okay. Thank you, Neelam. Okay. So guys, if you all haven't booked the exam, please try to book the exam today itself, because that way you'll get access to all the material that I'm sharing, and it will give you a good start for your preparations, right? Okay. Semi-variable cost. Now, semi-variable cost is also called hybrid cost or mixed cost, right? So it's basically a cost with a fixed element and a variable element. Can someone give me an example of a semi-variable cost? Electricity. Electricity is a good example, because electricity, you get a fixed monthly charge, and then there is also an element which charges you for the number of units consumed. So it's a good example for a semi-variable cost. Now, if you have a semi-variable cost, you have to separate the fixed and variable elements using a method called the high-low method, right? So I will not go into detail, but I'll just show you a quick example. Now, if we consider this example, when the number of units is 100,000, total cost is 560. Okay. And notice that as the output is increasing, the cost is also increasing, but not proportionately. What is 560,000 divided by 100,000? How much is it? 5.6. What is 657,000 divided by 120,000? Is it 5.6? 657,000 divided by 120,000. It's 5.475. So this is not a variable cost, because variable cost should remain, the cost per unit should remain the same. And it's not a fixed cost either. So it's a semi-variable cost. So how do you deal with it? You take the highest activity level and the lowest activity level. So it's 100,000 and 175,000. Okay. 100,000 and 175,000. Step 2, you take the difference between the cost. The difference between the cost is 875 minus 560. That is 315,000. and you divide it by the difference between the activity level. 175 minus 100, that is 75,000. So difference between the cost divided by difference between the activity level gives you the variable cost per unit. So variable cost by definition is the cost that changes with output. So when output is changing by 75,000, cost is changing by 315,000, which means roughly for every unit, cost is changing by 4.2, and that is the variable cost. Then you apply this into one of these two activity levels, right? So let's say for 100,000 units, the total cost is 560,000. What is the variable cost for 100,000 units? It will be 100,000 times 4.2, 420,000. So if variable cost is 420,000 and total cost is 560,000, the difference between the two is the fixed cost, right? That is 140,000. So guys, this is how you apply the high-low method. Okay, you won't be tested on calculations, but just know about this method. Now, one flaw or one limitation of the high-low method is that it only considers the highest and the lowest activity levels. It doesn't consider all the pairs of data. So we'll be discussing this in more detail in a future chapter, right? Okay. Now, classification of cost by nature. So by nature, you can classify cost into direct cost, which is also called prime cost. Example, direct material, direct labor, royalty per unit produced, and so on. And everything else is called overheads or indirect cost, like rent, depreciation, supervisor salary, insurance. All of those are overheads. Now, how do you explain a direct cost? Direct cost is a cost which you can directly trace into the final cost object. So for example, if you consider your smartphone, all the material that has gone into the smartphone, we call it direct material, right? Then all the people who have directly worked in the production process are called direct labor. Now remember, if the people, if you look at like maintenance people, security, right, cleaning people, those are not direct laborers. Direct laborers are refers to anyone who directly get their hands on in the production process. So if you take a garment, if you take a apparel factory, the people who are doing the tailoring, people who are doing the packing, they are your direct laborers, right? So that can be directly traced into the final cost unit. Remember guys, most direct costs are variable, but you also have, very rarely you do have direct costs that are fixed. For example, direct labor. Now, theoretically, we consider direct labor to be variable, but practically, if the company is paying a fixed salary, right? If the company is paying a fixed salary instead of a hourly rate, then is it fixed or variable? It's fixed. That way the employee will get a fixed payment no matter the time or the output. Then with regards to indirect cost, any cost which you cannot trace to the final object is called overheads. Most overheads, are they fixed or variable? What do you think? Most overheads, do you think they are fixed or variable? Most of the overheads are fixed. Very rarely you also find overheads that are variable, right? Now, for example, if you take electricity, there is a variable element in electricity. Okay. So I'm to give you another example. Let's say, let's think of a company that produces aircrafts. Right now, you are not producing thousands of aircrafts at once, no? Right? Usually, you produce most of the time one at a time, or it might be a few at a time. Let's just say, after finishing the production of one aircraft, you are spending money on cleaning material to clean the machines. Is it fixed or variable? Is it fixed or variable? It's variable. Why? Because you have to clean the machines after each and every unit, right? After each and every unit, which means it's an overhead which is variable, right? It's an overhead which is variable. Okay. So guys, any questions up to now? Any questions, any doubts, any clarifications? Anything not clear? Anyone? Okay. So let's move on. Now, total cost is direct cost plus overheads. Remember, direct cost per unit, you can easily identify and calculate, right? If you take any product, you can easily figure out the direct cost. But when it comes to overheads, overheads are generally spent as a total. So there is a detailed process that has to be followed when calculating the overheads per unit. Now, if you have studied management accounting previously, you would remember a 4-step process that is used for overheads. What are the 4 steps? Allocation. What is the next one? Anyone? Next step. First, you have allocation, then apportionment. Then service cost centers are put back to the production cost centers. We call it reapportionment. And finally, we calculate the overhead absorption rate, right? So these are the 4 steps that we follow for overhead to calculate the overheads per unit. Now, these 4 steps won't be tested in detail for operational case study because it's already covered in BA2. Okay. So later, if you have time, if you want to refresh the theory, you can just try out TFQ1 very quickly. Don't do it now, but maybe later you can do it. And that way you'll understand this better. Right, let's try out a few short questions. Just to ensure that you have understood the theory. So if you all have the tutorials, you can go to the section that says exam focus questions. Now, actually, these are not relevant for your operational case study. You can use it for your FLP assessments if you need, but I'm just throwing a few questions out just to understand, just to ensure that you all have understood all the things that I delivered so far. Right. Okay, guys, EFQ number 15 and 16. Okay, number 15. Variable costs are conventionally deemed to. Question 15 answer. Read the 4 options carefully and tell me what is the answer for question 15. Two features of variable cost. Total will increase proportionate to output. Variable cost per unit will remain constant. A is the correct answer. Variable costs are conventionally deemed to be constant per unit of output. Second one says vary per unit. No, it won't vary. The per unit won't vary. The total will vary, right? Be constant in total. No, total will vary. Per unit will be constant. Okay. Number 16, what is the answer? I'm sure all of you got this right. Number 16. Worker is paid a salary plus extra 5 cents. What is it? Semi-variable cost. Semi-variable cost. So question 15 answer is A. Question 16 answer is D. Can you explain 15 with an example? So variable cost, if you look at the slides that I shared earlier, look at the two features of a variable cost. The total variable cost will increase with the number of units. The variable cost per unit will remain the same. So it's the same thing that you are being questioned here. So the correct answer is A, because variable cost, the per unit value of variable cost is assumed to be constant. Okay. Right. Questions 17 and 18. Okay. Question 17. Which of the following cost is part of the prime cost? Prime cost refers to direct cost. So what is the correct answer? Some of you have mentioned it's A, some of you have said it's B. First one, cost of transporting raw material from the supplier's premises. Now, what does prime cost consist of? Direct material, direct labor, and direct expenses, right? So direct material consists of the material cost as well as the transport cost of bringing the material into the factory. So A is correct. The carriage inwards cost of raw material is considered to be a direct cost. Why is B not a direct cost? Why is B not a direct cost? What's the reason? Because although it says wages of factory workers, what are they into? They are into machine maintenance. Machine maintenance is a support service. It's not directly connected to the production. It's a support service. So because of that, B is incorrect. Depreciation always it's an indirect cost. So A is the answer for question 17. Question 18. Which two of the following are direct expenses? Which two of the following are direct expenses? There are two answers in question 18. What are the two? First one, cost of special designs, drawings, or layouts. Now, if you take the construction of a house, the design of the house, the layouts, those are directly connected to that house. So it is direct. The hire of tools or equipment for a particular job. If it's for a particular job, you can directly trace it to that job. So B is also direct. Salesperson is not a production related person. So definitely anything to do with sales, administration, those are all indirect. Rent rates and insurance will always be indirect. So A and B are the correct options. All right. Okay, so guys, that's the sorry, that's not the end of chapter 1 because we have one area to complete. What is the area? I told you I'll be doing it at last. What is the area? The area that is frequently tested. That's right. CGMA cost transformation model. So I'm now going to explain this model to you. It's very easy to understand. Now, CGMA, Chartered Global Management Accountant. It's a US body which is affiliated with CIMA, right? So these are 6 of the changes that are recommended to companies by CGMA, right? Management accounting related changes that will make the company better. Okay, CGMA cost transformation model is designed to help businesses to achieve and maintain cost competitiveness. The model has 6 suggested changes for organizations aimed at achieving this objective. Okay, so what is the main objective? To achieve and maintain cost competitiveness, right? Achieve and maintain, control over cost. Okay, so what are these 6 changes? First one, creating a cost-conscious culture. Now, what do you mean by a cost-conscious culture? That means everyone working in the company is concerned about the cost. Now, let's say, for example, there are 5 people in your family. Okay. So this is basically where all 5 of you in the family are concerned with controlling the cost of the family. Let's just say there is one family member. Let's say you. In your family, You're a reckless person. You don't switch off the lights when not in use. You sometimes just switch on the AC and you go somewhere. The TV is switched on. You don't, you are not careful with using water. You overspend on entertainment, right? Now, despite all the other members in the family being careful with cost, you are not. That will affect the overall family, isn't it? So creating a cost-conscious culture means trying to make sure that everyone in the company, from the director to the cleaning worker, right, all the employees in the hierarchy are concerned and conscious about the cost. And all of them are taking an attempt to control the cost. So reading costs are lower than rivals and set a competitive benchmark. Everyone in the organization should be motivated and enabled to reduce cost in whatever way possible. Technology can play a key role in reducing cost. Guys, how does technology help to reduce cost? Tell me. Tell me, how will technology help to reduce cost? What can technology do? Example. Automate, yes. By reducing the production cost, you can replace some of the manual work with machines, right? You can automate certain things. Now, recently, one of the buzzwords that you will be hearing a lot would be OpenAI, ChatGPT, right? Artificial intelligence, which can help you with, writing reports and so on, copywriting, right? So, I mean, certain people will lose their jobs. That's inevitable. But we have to understand that technology, in many ways, has helped the companies across the world to cut down or reduce or control their cost, right? Okay, then second one, understanding cost drivers. Now, if you go to a doctor and you tell the doctor that you're having a severe headache, you're having a severe headache, what will the doctor do? What will the doctor do? Will the doctor immediately give you some medicine and send you off? Is that what the doctor will do? Not really. What exactly will happen? I'm sure you all have gone to see a doctor for some sort of an issue. Yeah, checking the pulse. If you have ask you whether you have a family history of certain ailments like pressure, right? Check your heartbeat. Okay, check your pressure. Sometimes worst case scenario might ask you to take a scan of your head, right? Just to see whether there are any problems. So your doctor will understand the drivers of your issue, right? Your doctor will try to understand what is causing this problem. Same thing applies for a company. Same thing applies for a company. If the company's cost has increased, the management needs to understand what caused it. And by having a good costing system, you will be able to understand why costs have escalated and what we can do to control the cost. Have you all heard of activity-based costing? Have you all heard of activity-based costing? Okay, so this particular transformation model recommends the company to implement activity-based costing to understand the cost drivers. Because activity-based costing is a detailed method or detailed costing system that will break down the cost into different activities and logically understand what the company can do to control it, right? This involves investigating cost to determine why they change and how different variables impact the cost. Plans should be put in place to reduce the drivers of cost as well as the cost themselves. Now, okay, you don't have to necessarily implement activity-based costing, but any costing method that will help you to understand the drivers of the cost will be helpful. Okay, next one. Managing the risk that come from a cost-conscious culture. Guys, just practically think and tell me, if you are telling your employees to cut down on cost, what will be a negative implication of that? What could be a possible negative implication? If you constantly tell them to cut down cost, what might happen? What is an area that can get compromised? What is the feature of your product that can get compromised? Exactly, compromising quality or the value of the product. So, although cost-conscious culture is important, right? Although creating a cost-conscious culture is important, it is also important to explain to the employees that quality should not be compromised. You should balance between maintaining the quality and reducing cost. That culture should get inculcated, or you should try to introduce such a thinking pattern in the company. It is good to reduce cost, but if a particular cost reduction is harming the quality, then you should not. Then you should give the red light. You should not carry on with that. Okay. Managing the risks that come from a cost-conscious culture. For example, reducing cost may result in reducing quality and customer satisfaction. The organization should have a clear risk management process in place to identify, assess, and manage such risk. Number 4, ensuring products and services are profitable. Guys, if a company is selling loss-making products, most of their products are loss-making. What is the problem? What is the problem? That means the company is not, it will go into losses and it's not creating value to the shareholders. Okay, because when you are giving value to the customer, you should charge a fair amount from the customer. So you not making profits, or some products and services not being profitable might mean that either you're not charging enough from the customer or you're not controlling your cost properly, right? So we should analyze products and services that are not profitable and take action to make them profitable, right? Okay, it says it will be important that every product or service makes a positive contribution to the overall organizational profits. This will involve understanding what drives cost for each individual product and allocating shared cost to products as accurately as possible, right? So when you're calculating profit, certain values might be inaccurate. That is where a good costing system also plays a role, right? Okay, then number 5, maximizing value from new products. Maximizing value from new products. What that means is, before you launch a new product, you should do a thorough analysis of that product and see whether it will be profitable, whether certain features must change, right? Whether the pricing strategy should change, whether we can tap into new markets. So you have to try to maximize the return that the new product brings and also the value added to the customer, right? The potential profitability of new products should be assessed before production begins. Also, as part of product design, the product or service should be made as flexible as possible so that it appeals to or can be adapted to satisfy as many customer segments as possible. Now, for example, if you create a mobile app which you cannot update, then is the product flexible? No. You should create the app in such a way that if there are any new updates, the app is able to get updated. Okay. Then finally, consider the environmental impact of products, sustainability. So in all your products and processes, you have to ensure that the environment harm is minimized. Or in fact, if there's a possibility to do something good for the environment, we should do that, right? Negative impacts such as creating unnecessary waste can add cost as well as damaging reputation and sales. So these are the 6 changes that are recommended by the CGMA cost transformation model. Guys, are you all clear with this model? Everyone clear with this model? Okay, once again reminding you, this is a very frequently tested topic. So you can even take a note if you want, because when your exam is closer, if you have forgotten what this is, remember this is our first lecture and you can take a note saying CGMA cost transformation model was covered in the first lecture on 17th March 2023, right? Because I'm sure definitely you will have to revisit this recording when you're close to the exam because it's a very important area. I might remind you myself asking to go back to the first lecture and just check the area on CGMA cost transformation model. Okay. All right. So guys, let's take a 5-minute break. Let's take a 5-minute break and we will move on to the next chapter. Before that, there's a question. Can you tell how it is tested? Okay, I won't show you that right now, but in one of the future lessons, I'll just show you some past variant questions. Then you'll get a better idea on how it will be tested, right? Okay, so let's take a 5-minute break. Please join the class again in 5 minutes. Right, so that's the end of chapter 1. Right, so now guys, we will move on to chapter 2. Right, so what are we covering in chapter 2? Guys, we are looking at marginal and absorption costing. Right, marginal and absorption costing. So before that, let me remind you why it is important to calculate the production cost per unit accurately. Or let me ask you, in the previous chapter, one of the slides I explained why it is important to calculate the production cost per unit accurately. Guys, can you all give me 4 reasons as to why we need to calculate the production cost per unit? You can give me 4 words, right, reflecting the reasons. Why do we have to calculate the production cost per unit accurately? Anyone? To find the profit per product, yes, correct. Because if you know the selling price, you need to know the cost per unit in order to calculate the profit or the contribution, right? So contribution and profit, both I'll consider it as one. I know it's different, but for the purpose of this question, I'll consider them to be one reason. What else? I would say the main reason would be to set a selling price. For you to set a selling price, you need to know how much it costs you to produce it. because by selling this product, you need to make a profit. So if the production cost per unit is 80 rupees, and you need to also cover up other non-production costs, let's say that is 30 rupees, that's 110. You might sell it for 150 to make a profit of 40. So in order to set up a selling price, you need to calculate the production cost per unit accurately. Right. So pricing to value your inventory, because you can't simply put 200 units or 500 units. You need to multiply the number of units by the production cost per unit in order to calculate the inventory value. Controlling cost. So before you control your cost, you need to know how much your cost is. So in order to understand how to control the cost, you need to know what is your current production cost per unit. Planning. To plan for the future, you need to know how much is the current production cost per unit so that you can decide whether to continue this product or whether to discontinue it, or whether any changes need to be done to reduce the cost in the future. So these are 4 of the reasons as to why we need to know the production cost per unit. Okay, guys, give me 1 minute. I'll just adjust the screen. Right. Okay, moving on. Now, total cost per unit. Total cost per unit will consist of 2 parts. The total variable cost per unit and the total fixed cost per unit. There is no need for you to take these notes down. You can do it later. Now, once you download chapter 2, okay, actually I have already included them in the note, right? So there is no need for you to copy anything down. Now, the total variable cost per unit will consist of the direct production cost plus variable production overhead per unit plus variable non-production cost per unit. Now try to understand this clearly. Variable cost means the cost that will change with every unit. So what does it consist of? Firstly, the direct cost like direct material, direct labor, and other direct expenses. Secondly, any variable overheads like electricity. Thirdly, any variable non-production cost like sales commissions. So non-production cost consists of administration and selling and distribution. So variable cost per unit consists of these 3. Fixed cost consists of fixed production related cost per unit plus fixed non-production cost per unit. So fixed production cost will include, rent of the factory, supervisor salaries, machine insurance, cost like that. Fixed non-production cost will be advertising, then office rent, office salaries, and cost like that. Okay, now the first costing method that I'm discussing with you all is what we call marginal costing. You all might have heard of the term marginal cost before. Tell me another word for marginal cost. Tell me another word for marginal cost. What would be another word for marginal cost? Another word for marginal cost is variable cost. Guys, marginal cost is the cost of producing an extra unit. If you all have studied economics, you might remember marginal revenue and marginal cost. So marginal cost is the cost of producing an extra unit. So by definition, we are referring to variable cost. Okay, it's the same as variable cost. Now, if you are using marginal costing, please remember, you will value each unit that you are producing at the variable production cost per unit. Is this clear? Is this clear? So every unit you are producing will be valued at the variable production cost per unit. So what will it consist of? It will consist of the direct production cost per unit plus variable production overheads per unit. Do not include non-production overheads, because inventory should always be valued at production related cost. And if you use marginal costing, you will only take the variable portion of the production cost. You will only take the variable portion of the production cost. Guys, are we clear? Is this all right? Please confirm before we proceed. Is everyone clear with marginal costing? Now, some of you have studied marginal costing before, right? Okay, can you once say what is variable overheads? Variable overheads is basically like electricity, right? Variable production overheads are best example for you to think would be electricity. Okay, so basically I'll explain this one more time. Let's just say you are running a factory, right? You are running a factory producing, let's say, t-shirts, producing t-shirts. So every t-shirt that you're producing will be a part of your inventory, correct? Every t-shirt that you're producing, you have to place a value on it for inventory. What is the value that you're placing? You will value each t-shirt at the variable production cost per unit. So basically it will include the material cost for the t-shirt, the labor cost of producing the t-shirt, and any variable overheads like variable production overheads like electricity. You will not consider any of the fixed cost of the factory, like rent, insurance, depreciation. You will not consider that when valuing inventory. So the value of the inventory will only be variable production cost. Are we okay? Pragati, is that clear? Is that clear? All right. Guys, give me one moment, please. Just give me one moment. Right. Darsh, you had asked me about semi-variable. So how it works is, when you have a semi-variable cost, what should you do? You should always break it into fixed and variable using the high-low method or some other method. So the variable part of it, if it's a production related cost, the variable part of it will be included in the cost per unit, right? Where can we get this recording? Because I got late and joined just now. Okay. The recordings will get uploaded to the Google Classroom. And to access the Google Classroom, you will have to book your OCS exam for either May or August. As soon as you make the booking of the exam, you will get access to all the recordings and all the material and resources that I'm sharing. Yeah. Okay. Right. Example number 1. Before we go to example 1, let me just show you the format of the profit statement. Okay. Oh, sorry. Example 1 is different. Right, guys, take a look at example 1. And after this, I will show you the profit statement. Read example 1, and I would like you to tell me what is the cost per unit for valuation that we will use? What is the cost per unit for valuation in example 1? Anyone with the answer? So it says product MS consumes 3 kilos of direct material and needs 2 hours of direct labor. Sales and production were budgeted at 20,000 units, but only 16,000 were actually produced and 14,000 were sold. There was no opening inventory. Each unit is sold for $130. Direct material cost $4 per kilo. Direct labor is paid $22 per hour. And variable overheads of $6 are incurred for each hour worked. Budgeted fixed production overheads amount to 400,000. Okay, now guys, how many costs do you see here? Direct material, direct labor, variable overheads, that is variable production overheads, fixed production overheads. Out of these 4, how many do we consider in the cost per unit? We should consider direct material, direct labor, and variable production overheads only. Okay, now guys, tell me how much is the material cost per unit? It consumes 3 kilos and each kilo the cost is $4, right? So 3 times 4 is 12. What is the labor cost? What is the labor cost? 2 hours of labor per unit. Each hour you're paying them 22. So 22 times 2 is 44. And also for every hour they are working, there's a variable overhead of $6. So think of it like electricity, right? For every hour they are working, you have to pay the laborers separately, you have to pay the electricity separately. So what is the variable overhead cost per unit? 2 hours of work times 6, 12. So now add the three together. Material 12, labor 44, variable overheads 12. How much do you get? Very, very good. 68. 68 is the cost per unit for valuation. Now, how many units are in the closing inventory? How many units in the closing inventory? You produced 16,000, you sold 14,000. So 2,000 units in closing inventory. So the inventory value is 136,000. Are we okay? Right. So you don't have to worry about copying this answer because I'll be sharing the slides with you right after the class. Okay, let's move on to TFQ1. Before that, let me just take you through the profit statement. I'll give you all a minute to go through this profit statement and then I'll explain it to you. Just have a look at the profit statement format. Right. Now, you start with sales revenue. That's how we normally start a profit statement, right? So sales revenue is first. Darsh, you have said, can you explain it through an example? Yes, that's what I'm about to do next. Okay. Then, guys, normally after sales revenue, we have cost of sales. No? When you use marginal costing, we call it variable cost of sales because you value your inventory only at the variable production cost. So you have the opening inventory, you have the variable production cost, and you have the closing inventory. Remember, both opening and closing inventory are valued at variable production cost per unit, right? Now, for example, in this previous example that we did, what is the cost per unit for valuation? What is the cost per unit for valuation? How much is it? In example 1, what is the cost per unit for valuation? You see it right in front of you. How much? All of you got the correct answer for this. 68. What is the value of the production? Now, the value of closing inventory is 136,000. What is the value of the production? We have produced 16,000 units. 16,000 times 68. 16,000 into 68. That is 1,088,000. Okay. Right. Then, so remember these three items are valued at the variable production cost or the cost per unit for valuation. Then you transfer it to the next column. There should not be a line below this. It's a mistake. So then you have the variable administration cost, which you will deduct, and the variable selling and distribution cost. So basically now we have deducted all the variable cost. So sales revenue minus all the variable cost, we call it contribution. Sales revenue minus all the variable cost, we call it contribution. And after that, we deduct all the fixed cost. That gives us the net profit. Are you all clear with the format? Are you all clear with the format? Okay, superb. Guys, let's move on to question number 1. Right, so I hope you all can see the question clearly. What I want you to do, go through the information in front of you, and I want you to determine what is the cost per unit for valuation. Like what you did in example 1, where all of you got the answer correctly as 68. Like that, for this question, check and determine what is the cost per unit for valuation. Okay, 15.5 is what most of you are telling. Guys, very close. Shubhan, your value is correct. The second value that you have given is the correct one. 15. Why not the 0.5? Because look at the 0.5. What is it? Variable selling overheads. I told you, you cannot value inventory using non-production cost. So what are the components you should take? Direct material, direct labor, variable production overheads. Direct material, direct labor, variable production overhead. So the addition of these three will be 15. So cost per unit for valuation is 15 per unit. All right, can I start? Can I start? Can I start the discussion? All right, super. So guys, you're given information. Okay, there's a comment, but in the format, we have variable selling and distribution cost. Yes, when calculating profit, you should consider it, but cost per unit for valuation, watch carefully. Cost per unit for valuation should be only direct production cost plus variable production overheads. Remember, you can never value your inventory using non-production cost. It doesn't make sense. Okay. The cost per unit for valuation of inventory should never include non-production cost. When calculating profit, you have to deduct the non-production cost, obviously. All right. Okay. Now, the question says, prepare a profit statement for each of the 4 months using marginal costing principles. Now, I have already put this into an Excel sheet and I will work it out for you, but I need your help with certain figures. Right, let's start with January. Now, in January, can you tell me the sales revenue? Guys, what is the sales revenue for January? We have sold 2,000 units for $30 each. 2,000 times 30, 60,000. Right, that's the sales revenue for January. Tell me the opening inventory of January. How many units? How many units in the opening inventory? Read the question carefully. 0. There were no opening stock at the beginning of January. 0. Right. How many units did we produce in January? How many units? We produced 2,000 units. At what value should we take each unit? What is the cost per unit for valuation that we just discussed a moment ago? 15. So then what is 2,000 times 15? 30,000. So the variable production cost for January is 30,000. What is the closing inventory? Closing inventory units in January? 0. We produced 2,000 and we sold 2,000. There was no opening inventory. 0. So 30,000 comes as cost of sales or variable cost of sales. Then tell me how much is the variable selling overheads for January? For each unit you're selling, the variable selling overheads is 0.5. 0.5 per unit into the number of units you sold. You sold 2,000 units multiplied by 0.5. Yes, the answer is 1,000. 1,000. So the contribution will be 60 minus 30 minus 1,000. 29,000. There are no variable admin overheads in the question, right? So this is the contribution. Guys, are we clear up to now? Are we clear up to now? Okay. Then guys, what are the fixed costs? Now, these are all budgeted fixed costs. But notice that the question is telling you actual cost incurred were as per the budget. So all the costs that we budgeted for are the actual cost also. So what are the fixed costs? 10,000 for fixed production, 2,000 for fixed admin, 3,500 for fixed selling cost, right? So we put these three and we have the profit. $13,500, right? 13,500. Okay. Now, what is the sales revenue in February? Sales revenue in February? 2,100 units at 30 each, 63,000. Opening inventory in February. Opening inventory. There is no closing inventory in January, so opening inventory in February is 0. Variable production cost in February. Variable production cost for February. What is the variable production cost for February? We have produced 2,100 units. How do we value this? What is the cost per unit for valuation? At 15. So what is 2,100 into 15? $2,100 into 15 is 31,500. 31,500. Closing inventory for February. Closing inventory. There was no opening inventory in February, right? You produced 2,100. You sold 2,100. So there is no closing inventory in February either. So the variable cost of sales will be 31,500. What will be the variable selling cost? Variable selling cost. Variable selling cost. You sold 2,100 and each unit you pay a commission of 0.5. So 2,100 into 0.5 is 1,050. Okay. Then you have the contribution. 63,000 minus 31,500 minus 1,050. Fixed cost will be the same. So your profit is 14,950. Guys, do you all need a clarification with any of these figures? Is there any figure that I have worked out so far which you don't understand? Okay, so looks like all of you are 100% comfortable with everything I have done. That's good. Let's move on to March. Sales in March, sales revenue in March. Sales revenue in March. Same as February, isn't it? March also you have sold 2,100. So 63,000. Opening inventory for March, 0. Production cost for March. Production cost for March, variable production cost for March. You have produced 2,300 units. Each unit, the cost for valuation is 15. So 2,300 times 15 is the cost per unit for valuation. $34,500. Now, is there closing inventory in March? How many units? You produced 2,300, you sold 2,100. There is 200 units left in March. And at what value should we consider? 200 times cost per unit for valuation is 15. So 200 times 15, which is 3,000. That's right. So what is the variable cost of sales? $34,500 minus 3,000, 31,500. Variable selling cost will be the same as February because you sold the same amount in February. So I'm going to put 1,050 again. So contribution, fixed cost will be the same. So notice that the profit in February and March are the same. Why is that? What's the reason? Why is it the same? Because you have sold the same number of units. Although we produced more in March, that extra goes as closing inventory. It gets pushed to the next month. So that's why the profit figures will be the same. Okay. Now let's look at the last month, which is April. So guys, April, what is the sales revenue? $30,000. That's 2,000 units into 60. Sorry, 2,000 units into 30. What is the opening inventory in April? Opening inventory. Opening inventory in April is the closing inventory of March. 3,000, which is for 200 units. What is the variable production cost for April? The value? $1,900 units at 30. That's 28,500. Okay. Now tell me how many units are there in closing inventory at the end of April? You had 200 units at the start of April, right? You had 200 units from March at the start of April. Plus, you produced 1,900 in April. So 200 plus 1,900 is 2,100. And from that, you sold 2,000 units, which means you have 100 units left in inventory. Is this clear? Is the closing inventory for April clear to you? Okay, then what is the value? What is the value? $100 into 15,500. Right. Then 3,000 plus 28,500 minus 1,500. That's 30,000. Variable selling overheads will be the same as January because in January also you sold 2,000 units. Fixed cost will be the same and therefore the profit will be 13,500. Right. So now we are done with the profit statement using marginal costing. Okay. So understanding this is very important and you will have to understand this further, or you will understand it further in the next class when I cover absorption costing with you. Because when we do this using absorption costing, the values will be different for certain months. All right. Okay. So now since we have just 5 or 4 minutes left, I'm not going to start with absorption costing now. We'll be done for the day. Any questions before we wrap up? Any questions, guys? Feel free to unmute and direct the questions if needed, or you can type and send it through the chat. only related to syllabus. Darsh, can you elaborate? I'm not very sure what that means. So basically what I'm covering in these classes for P1 and F1, I'm covering it with a style in such a way that it's useful for the operational case study, right? For the operational case study. So I'm not going into very heavy detail with the numbers, right? And I'm not expecting you all to do a lot of numbers, because at the OCS you have to do explanations. You have to understand how the numbers work, but you have to mainly give explanations for the numbers that's already calculated. So guys, if you all have registered for the exam, you all can Neelam, are you in the meeting by any chance?
Harshan, we are done with the session.
Yes, actually, I just got a message, Neelam, from a student saying that she had booked the exam for August today. So then, yeah, she just has to drop you an email or something like that.
Yeah, sure. Once I think so, Namrata, I have messaged her. I will explain her what needs to be done, and then I will provide the access to her for the access of the material, basically of the Google Classroom. I just want to address to the students that as Harshan is going through with the P3 and P1 basically. So the students, if you are left with the competencies to complete in your FLP portal, please start completing the same as the faculty is teaching to you. You can go to the FLP portal, get it cleared. If you have any query, come down, or you can just let us know, drop an email on CIMA India, so that we can pass on to the Harshan to answer your queries in the next batch or the next lecture. And Harshan, if I'm not mistaken, like next session will be on 19th of March, that is on Sunday, and it will for two this thing, that is an P1 and E1. First session will be 4 to 5:30.
Neelam, I think it will only be P1. Let me just check. E1 will be happening in April. So the next session will be on Sunday, 1:30 to 3:30. Yes.
Sorry, P1 will be 4 to 5:30 and F1 will be 5:45 to 7:15. Two sessions are there on Sunday.
No, Neelam, I think I sent you an updated timetable. Yeah, in the updated timetable, I think I made a small change, Neelam. So it will be 19th Sunday from 1:30 to 3:30. It will only be P1.
Okay.
Yeah.
Okay, fine. I will just check the timetables in that case.
Okay, sure. All right. Okay, guys. So then I'll see you all on Sunday. And on Sunday, we will continue with absorption costing. Thank you.
Thank you, student. We will be uploading this recording on the Google Classroom to access the same. And student, if you have any other friends who are giving an operational case study for May or August window, please ask them to register for the sessions and avail the benefit. Thank you so much.